Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. August 7th, 1 o'clock on the East Coast. Let's get this out of the way. August 7th, interesting day. The birthday of one Wilford Frost. That's a friend of both Dan Nathan and myself. I think, Elizabeth, you were on his show from time to time. True or false?
I was when he did the closing bell. Yes.
Happy birthday to Sarah Eisen. I mean, same day. They shared a show together. Crazy. Happy birthday to legend Bill Griffith of CNBC fame. Wow. And, of course, Brian Steele, who nobody on this podcast knows, probably don't care about, but he's another CNBC Johnson. So that's that. It is August 7th. It's 1 o'clock on the East Coast. It's Guy Adami. Later, we have Pat Reilly joining us. He's coming fresh off the Olympics and doing some scouting for the Miami Heat.
We see what you did there. We see what you did there.
It's not that, Pat Reilly.
He is one of the fine professionals over there at FactSet. Made a bold call about interest rates, Guy, a few weeks ago. So we're going to talk.
Yes, he did. Yes, he did. I was just joshing you, little tomfoolery here on a Wednesday. Anyhow, let's get right to it. Let's go to the rundown because I just like doing this. Stocks Party On. That's obviously an homage to one of those shows. Wake Me Up When September Ends. That's one of Dan's songs. Isn't that the Green Day?
That is the Green Day.
Mm-hmm.
But I actually didn't do that. That's kind of an overused sort of thing.
Yeah, listen, I agree. I didn't write it. Way up, down, and all around. That's sort of gross. And audience Q. Audience Q&A. So let's get right into it. We've had this bounce in the S&P. Let's throw our S&P chart up because why not? The bounce makes sense in the context of the sell-off we've seen for the last couple of weeks. I will tell you, if I'm being honest, I think we got a little overdone. Carter had mentioned yesterday, Dan, that we thought there'd be some gaps on the upside that we would fill. That's seemingly being done. So here we are.
Yeah, I mean, this is an interesting one. It did fill in that gap. I think that was from Friday, guys. So that was the July jobs report, and it kept on going.
All important.
Obviously. Yeah, the all important. But look at today's action. Maybe Jacob could pull up like a 3-day chart or so. We saw yesterday we were up, 2% or something like that in the S&P, gave back half of it towards the end of the day. Look at today. It looked like we made a new high, right? We filled in that gap when I say new high over the last few trading days, and it's kind of giving it back. We were just on the CNBC Fast Money call, and Guy said, watch out for this one because we're just losing momentum to the upside. You think that there's a possibility that we could make some lows of the other day from a closing lows perspective. Liz, when you look at the S&P after a bounce like this, that Monday morning opening, I think, Guy, you and I have to go back many, many years to remember that sort of panic in a handful of names. But how are you feeling about this bounce, and how are you feeling again about the velocity to the downside that we saw Friday into Monday?
Yeah, well, Guy, I mean, what happened on Monday is that trusty yield curve inversion turned positive. It was just a whisker. It doesn't count, but it happened. And to me, that just means it's a warning that it's coming, and it's going to happen in a lasting way sooner rather than later. So on Monday, I think and we talked about this on the show a little bit on Monday too, but we know that markets overshoot on the up and the down. Monday was a product of a few different things. I think we came into it reasonably fragile because of bad data on Thursday and Friday. So investors were a little shaken by that. This is a different market environment. This is no longer a market environment where we cheer cooler data. So investors were already looking at the negatives. I think what's interesting about it is when we're looking at the bounce now, the velocity of the bounce, the size of the bounce is much smaller in magnitude than the velocity and the size of the drawdown on that data from Thursday and Friday and on the fears that happened on Monday. So that's also indicative of this being just a different market environment and something that we all need to heed the warning of. I think this bounce is natural. I think it was probably pretty well expected by most investors because of the drama of Monday, but I don't think that it's durable.
All right, we have not had the opportunity to chat, you and I. Monday was an interesting day, was staggered day. Dan and I, then it was Dan and Carter, then it was you and Dan. So this is the first time we've seen each other since, again, as I said, the all-important jobs report from Friday. This is something that I know that both of us have talked about, and you've used the term escape velocity, and that move from 4.1 to 4.3 in the unemployment rate, I think, listen, it clearly surprised some people because we saw the market reaction, but Is this what you've been expecting? And do you think there's more to come? And, you have mentioned the Somm rule. People are saying, again, Claudia Somm has said, maybe we should all take a step back. Other people have said, well, if you want to nitpick, maybe we haven't sort of kicked it in, but thoughts on all of that.
Yeah, so apparently there are some measures that need to confirm the Somm rule, which haven't happened yet, and that's fine. I think the issue, first of all, is that the unemployment rate obviously went up faster than expected. I did write about this in my mid-year outlook. It was the few things to watch for. I listed 3 things, the first of which was the U.S. election, the second of which was the unemployment rate rising above 4%, because that is a different environment. And because we've been in this period, this protracted period of sub 4% unemployment, I was concerned that investors, even though above 4% is not necessarily bad, but I was concerned that investors would look at a number above 4 and get nervous just because it seemed so much higher than what we thought it should be. So this is what I expected. I did expect markets to get jittery with unemployment rising. What happened on Friday with the jobs report, I think, was probably natural, especially because of the Somm rule triggering and because of the accuracy of that rule. Now, Powell said it's not a rule, it's a statistical regularity, whatever, potato, but it literally has not been inaccurate once. So every time it's triggered, there has been a recession to follow. Now, of course, it doesn't have to stay that accurate.
What's the time span on average from it being, triggered to...
somebody actually put I don't know off the top of my head. We can probably figure that out pretty quickly.
On the Twitter, is that where that was?
I think I saw it on the Twitter. I'd have to check though. It's not very long afterwards. I want to say it's inside of 6 months or so.
Yeah, but I just want to make one point. So we talked about this earlier in the week. The Fed GDP now, they're revising Q2, right? Or actually Q3, GDP growth from 2.5% to 2.9%. So again, you can kind of quibble about how that is, calculated and what it means, because we've talked about, earnings season. We've seen no shortage into this week about what Disney said in parks and the like here. I want to mention this too. Novo Nordisk, which makes Wegovy, is down 8.5% today. They missed their sales estimates. And we talked about a guy on Fast Money last week. This is like the ultimate discretionary purchase, if you think about it. And it's a big ticket purchase if you're doing a long time. Half the scripts, and maybe Jacob could throw NVO up there, half the scripts are not covered by insurance. So I just think it's interesting to keep these sorts of things. This is the first time, pull it out 5 years, Jacob. First time below that 200-day moving average in how long here? So you're seeing a breakdown, of some of these stories, and it's not too different. We've been talking about this mega trend, not too different than generative AI, some of that sort of stuff. So
but these stories they're technological advancement just in healthcare. Yeah. Right. So it's not AI, but it's a similar vein as AI. So it's giving back similarly to what AI is giving back. And I think the difference here with these drugs is that there has actually been profit. There has actually been tangible benefits. People are buying them. But it's happening.
It's not too different though in generative AI, how, this is going to become something of a commodity at some point with all the competition. Pricing is going to come down, all the like. I just want to go back really quickly to the SPX here. We're about 130 handles, guy, off those lows from Monday. So keep an eye on that level. I think it's 5130 or so, 5,000, which is basically the 200-day moving average. That's going to happen here, people. So, I guess the question for me, what is the test when we get back towards those lows? Let's pull up the NDX for a second, because obviously some of the hardest hit stocks on the opening on Monday were some of the stocks that, make up a disproportionate of the weight of the NDX. And what's interesting to me here about this is that part of this generative AI trade is coming undone. So let's just look at, let's walk through this. So Supermicro, we talked about it last time in Fast Money as the results were coming out here. This stock is down. I'm looking at about 16%. It was down a little bit more. What do? They're a contract manufacturer for servers that go into the data centers, and those are all used, right, to train these large language models. You know what goes in the servers? NVIDIA's high-end GPUs, right? Well, you know who is a competitor of Supermicro? Dell. Let's pull up Dell for a second here. This thing is what, guy, down 40% or so. So we've been talking about Micron, how that joined the party, the generative AI, because obviously these servers need a ton of memory. Well, they're all coming undone right now. And I feel like, look at that. I mean, look at that move right there in Dell. And that literally has retraced the whole move since people started getting excited about this. So thoughts here, guy. And the last point I'll just make is that people were not particularly excited about Amazon had to stay despite their foot still on the pedal as it relates to CapEx. I think you're getting into a situation where if the CapEx continues, but you see a slowdown in some of the demand for these businesses that have been capacity constrained, pretty soon you're going to have way over capacity.
I don't know. Throw the super micro chart. I mean, Dell is interesting. I agree. I mean, it's going to, if we can get down to about 75 or so, we'll round trip the entire move from the fall when some of these analysts started to get very bullish. And by the way, very correct on it. But the round trip is, I think, interesting. But the super micro move, I mean, now down probably what, 60%-ish from its prior all-time high, which is remarkable. And quite frankly, it, you know, probably has more room to go. And this is something that Danny Moses talks about all the time. You know, what are the buy points here? And what we have said, or at least tried to have said, when you start to see margin compression in these names, which is, by the way, exactly what we saw with Supermicro, that's going to be a huge warning sign because it typically doesn't turn back the other way. And that's what we've seen, at least starting to see with some of these companies. And, you know, people want to point to price to earnings and those types of things, which I get, you know, for some of these stocks are not ridiculous, but price to sales clearly are. And the problem is going to come in the form of, again, margins compressing, and it becomes a sell first, ask questions later. And that's exactly what you're seeing here. Now, NVIDIA is seemingly the last stock standing, but at a certain point, gravity is going to take hold as well, which has also been my concern. And, you know, when passive, and I've said this 100 times, if passive ever becomes active, what's worked for names like NVIDIA and Apple on the way up, to the extent that they're in, you know, hundreds of ETFs, of which they're a top 15 holding, the same thing happens on the way down. And people will blame it and say, oh, it's because of ETF. Well, you know, you didn't champion it when it was going higher. So it stands to reason the same thing can happen on the way down.
And one thing I just want to say about NVIDIA, I think investors showed their hands on Monday when you think about it. So down 14% opening, it shows that, okay, that you know, they got an itchy trigger finger here. I want to make one last point, Guy, on the Supermicro and the Dell, and we talked about this on Fast Money last night. The margin degradation that's going on there. So Dell got to the party here, and you know, there's a lot of competition on price. They went from 17% gross margins a year ago in that quarter just reported to 11% this year.
That's huge. That is huge.
But the most important part about this, Guy, is that Dell has doubled that gross margin at 22%, which actually is super low when you think about hardware versus software and the like. So they have some room to play on price. So we'll just leave it at that. Before we get to Pat Reilly, Guy, do we want to do a quick hit on yields? Because obviously,
yeah, absolutely. You should definitely throw those up. I know Elizabeth has some thoughts on that. And, you know, again, for any new viewers or listeners today, I want to be crystal freaking clear. You know, I thought rates would go higher this year. That was wrong. But what I did say is, if in fact rates do go lower, it's not going to be for the reasons that you want them to be. That proved to be correct. I'm not trying to play both sides of the fence. What we're seeing is, and you know, EYT can opine on this quickly, the Bank of Japan is clearly blinking. I mean, they have some issues over there that are obviously manifesting themselves in these global markets, global currency markets. When you see, you know, 2 sigma moves, 3 sigma moves, not only in currencies, but in their equity markets, it's staggering. I mean, you don't typically see, you know, a 12% down move followed by a 10% up move. So that typically is not the sign of a bottom, in my opinion. It's more the sign of some of the churn around the top. So keep your eyes open here, people. And if rates start going higher here, which again, you know, I have no idea, you know, what is that on the back of? It's clearly not on the back of economic growth. So just something to watch, Dan.
Okay, so this Japan thing, I just want to make sure people understand this. There's something called an interest rate differential, right? And that's the spread between basically the 10-year yield in the US and the 10-year yield in Japan. Of course, they're different right now. There's a spread of, let's call it 3%-ish, something like that. So as that spread narrows, you would think that the currencies would come better into line. If the Fed cuts rates, this is what I think was so contradictory about what people were saying on Monday. If the Fed cuts rates, yes, perhaps the yield differential will narrow, but the dollar will also weaken. And that sends the currency pair into the wrong direction. If the yen continues to strengthen, we have to unwind even more of the carry trade. And some of the math that we have done, when I say we, I mean Mario, have done, shows us that given where the yield differential is right now, the yen should actually be about 10 points stronger than where it is. So there's still plenty of room for the yen to continue strengthening. And if it just took a little bit of a move over the weekend to send Japanese markets into a tailspin, I mean, circuit breakers on equities, circuit breakers on bonds, bear market in the span of 3 trading days, if all it took was a little move, if we've got another 10 ticks to go in the yen, there's going to be more volatility. So what I learned on Monday was that no matter what, the market still thinks that cuts save the day, and they don't. I also learned that growth investors in particular think that cuts save the day because their stocks are getting hit the hardest. And suddenly we were clamoring for a 50 to 75 basis point emergency cut. But volatility is not an emergency. Valuations going from 21.2 times down to 19.9 times is not an emergency. So there's no emergency cut coming unless something really breaks in the financial system. Some of this is a shakeout from extreme levels. The last thing I'll say about this is, and I'm not calling for a financial crisis, but most financial crises, if not all financial crises, are caused by excess risk taking or excess positioning in some portion of the market. If that excess positioning is in the Japanese yen carry trade, it needs to unwind. And it's okay for us to unwind it systematically if we have painful bouts of it. The scary part, and the part that I think would warrant an emergency cut, is if it all unwinds at the same time, everything starts catapulting down and it becomes contagious across the globe. That has not happened yet, but there's still a possibility that it could get worse.
Okay, everybody stop. Before we bring in Pat Reilly, stop, Dan. Don't even say a word. You know, we don't rehearse. We don't rehearse. I mean, I think it's pretty clear. Number one. Number two, I actually brought up exactly what Elizabeth was saying and her tweet last night on CNBC's Fast Money. I mentioned that EYT tweeted out that inflation-adjusted yields suggest that dollar yen should be trading about 134 or so. And I dovetailed that with the JP Morgan commentary about this yen carry trade unwind being about 50% over. So she is spot on with that. Number two, for all the Johnsons out there, and there are many huge Johnsons, by the way, calling for an emergency rate cut, and that's you, Jeremy Siegel, who I know is watching as we speak. Are you effing kidding me? I mean, that was what did I say, Dan? Didn't I say that was pathetic? Did I not say that?
You had a bit of a rant on Monday night.
Well, because it's ridiculous. He embarrassed himself. He embarrassed himself, not understanding that what he was suggesting would have just made the problem that the market was trying to deal with worse. Back to you.
Well, you know, you've had that right. I just want to mention this because we started the show off of what your call was at 12:30 when we were talking about it. I just want to mention this, that Microsoft's 2% off its highs, JP Morgan's 2% off its highs, Home Depot, this is one that I think is interesting to keep an eye on, also a few percent off its highs. So we're seeing a precipitous sort of weakness. Nvidia's 5% off its highs here. So interesting price action. This is the sort
of
quick,
Dan. Real quick, because of breaking news. And Peter Bookvar just tweeted this, and the S&P just went flat. Terrible 10-year auction, which, by the way, should not be surprising given where yields are. Anyway, back to you.
Yeah, no, just interesting that we opened up the way we did and are starting to have this midday weakness. And by the way, I was listening to somebody the other day when somebody said it opened up down.
So hold on a second. That's who that is. I love that's Andrew Ross Sorkin, who I love. I was on. I did. What do they call that show, Dan?
Squawk and Friends.
Yeah, I did that a few times. And I said to him in a commercial break, I'm saying, Andrew, this is not a criticism. Okay. It is not in all. I did this myself. I said I was on the trading desk one day and I went up to a guy named Tony Lotto and I said, I think it was General Electric opened up down 1.5%. And he said, no, it didn't. I said, no, actually it did. He goes, no, it didn't. I said, well, actually that, and he goes, I want you to go back to your desk and think about what you just said. And I was so flummoxed by that. And then somebody tapped me on the shoulder. He goes, stocks either open up or open down. They don't open up down and they don't open up. But thank you for that.
That's the funny thing about this business is like, can you think about how little you knew when you started? Like even just the vernacular is pretty amazing, but it kind of grates us a little bit. All right, Guy, let's bring him in because listen, we've had like a lot of fun with a lot of our friends from FactSet. We've gotten to know many of them. We were down at the FactSet Focus Conference. You were there. Yeah, you were. So we know we can put names with faces and the interactions. But this guy made a call, which, oh, there he is. Okay. So that's Pat Reilly, guy. Give him his due. Give him the title.
Well, I mean, he's rocking the beard, which I totally dig. I mean, you got the you got the whole thing going on.
Whole rig.
I mean, I will put you, if I had my choice of Pat Riley's right now, I take you. Anyway, back to you.
All right, Senior Vice President, Senior Director, America's Analytics, Pat Reilly, CFA. Thanks for being here, Pat. You know, one of the things, you know, our crack producer, Amanda, she saw a report that you put out a few weeks ago, and we thought it was pretty bold. You want to walk us through what you were thinking on July 23rd, and how has that thought process changed at all, if it has?
Yeah, great. Thanks for having me. Really appreciate the opportunity. So all this actually really starts back on the release of the June CPI data in mid-July, where, if you recall, we're mid-July, market really bounced with, oh, rates are going to cut, inflation's under control. And so I had that initial thought process of, if 100% of the people think that's likely, maybe it's not. and so kind of drilling down into that more and carrying it into the following weeks, it's just stood out to me that I think that the market is overshooting. And where you're hearing commentary, certainly you mentioned Jeremy Siegel and the 75 basis point cut. You're hearing now about 50 points is going to be the new first cut. I'm not a hawk. I'm not a perma bear by any stretch. I think it's a little bit of a summer slowdown. There's some seasonality to it. And all things considered, you're going to see that cut first in November, not September. I just think that the numbers are not that bad, ultimately.
Which, by the way, if they waited until November, it'd be the longest Fed pause ever.
Yeah. And thoughts on that. Okay. So we've been throwing a lot of numbers at, the SOM rule and this and that, whatever. You've been saying this for a while, Liz. Be careful of that, obviously getting the inversion back to flat-ish and going higher. You also talked a lot about the lack of volatility in the equity markets. I think we got to like 355 without a down 2% day. And I think what Pat's also saying is that, okay, so maybe there's some seasonality here. We might get back to some hotter data, right? And again, that might suggest, I think what you're saying, Pat, is that, yeah, we're going to push out of September. So do you still feel that way after everything we've seen? Because Guy just said, be careful what you wish for. If the data continues to get cooler, might we see, listen, expectations for September are good to go.
Yeah, I know. If you look at the policy tracker in FactSet today, you'll see a little bit of a total change, right? So how to read this and how to interpret this, because there's a lot going on. In the top chart, the yellow bars are a month ago. So expectations based off of future prices, off of futures a month ago. Your 1 week view is that magenta, and then blue is as of yesterday's close. And so what I think is really telling is, a month ago, there was still a sizable percentage of probability that rates wouldn't change. And then over the past month, you actually see now that shift is the expectation is not just a 50 basis point move in September, but also potentially a minimum of a 25 basis point in November with room for a 50 basis point. As of close of business on Monday, this was actually 100% 50 basis points November, 50 basis points September. So, just the magnitude of those cuts really seems surprising to me, or seems aggressive for how transparent this particular Fed has been historically, right? And so even if you go back to the Fed minute release and then Jerome Powell's press conference, I wasn't turned into a bull for rate cuts based off of that. I felt like his statement, I'm paraphrasing a little bit, which was a cut could be on the table. Well, theoretically, a cut could be on the table at every meeting, just like a cut could, or an interest rate increase could be on the table at every meeting. I just think that this Fed has really gravitated toward transparency. And I think the next minutes that you'll see, or the next announcement, is we are ready to cut. I think they will be that deliberate. And then, when Guy, you hit the SOM rule, I think it's incredibly important to note, with Claudia saying, hey, maybe the volume is a little too loud. I think all of these start to tell a really nice holistic story. And then as I start to look at the jobs number, the reaction on Friday really stood out to me from the standpoint of, hey, it's summer. I'm in the client-facing business, right? I work across our specialty product mix. Anecdotally, I can tell you my clients have been enjoying the summer, right? People are out. Certainly they're focused on their market and the job, but selling may go away. Maybe it's more like sell in July, come back in September. You know, that's just, it just stands out to me. And when you start to look at July as one data point, I started peeling back the onion and looking at previous summers. And there's a consistent slowdown that you see. So while the number itself is weak, and especially over recent timeframes, historically, it's not that bad a number. And I'd actually go one point further and say within inflation itself and within employment, you actually want to see a little bit of an increase. You want to see some slack in employment if you're hoping to minimize or reduce the impact of wage inflation.
All
Right?
fair,
So
all great points. No, and I'm totally with you. So here's I'll throw something at you because you're obviously a student of history. There are a lot of people, myself being one of them, that fears we're going to get another type of early 1970s situation where the Fed thought they had defeated inflation only to have it come roaring back. And a gentleman named Arthur Burns, who had a storied career prior to that, will go down in history as the person that basically screwed it up because they didn't defeat what they were trying to. I think Jerome Powell and his mates are keenly aware of that, yet they're seemingly going down a similar path. Is that a concern worth having, or am I making too much out of it?
In terms of a broader policy mistake, or in terms of
broader policy mistake and the potential to have another early 1970s situation?
I think it's definitely fair to have that in the risk profile. I tend to think that rates today, while they're restrictive, are not historically high. And so I'm content to actually wait to see what the data looks like. We'll see the next CPI print, I believe, next week. And you'll see another one before the September Fed meeting. So there's a risk, but I like the trend with inflation. When you look at rates, it kind of depends on the time frame you look at, right? If you're thinking over the past 15 years, so go back to the great financial crisis, rates today are really high. If you go back further in time to, say, the mid 80s, rates are actually a little bit below average, right? I mean, you see, almost a 64 basis point under average in terms of current rate. And so, I started to play around with this in terms of even like great moderation, however you want to define those Greenspan glory years from call it 85, 87 to 2007. Rates today are just not historically out of whack. And so when you hear these market calls about a 75 basis point cut, or over the next year and a half, we expect 150 basis points. Maybe that could happen, but I don't think that having a choice around capital allocation is a negative thing for investors.
So one of the things that I think is interesting to look at right now, based on what's happening with the Fed funds rate, what's happening in the market, and your concern, Guy, which I did share for a long time about inflation reaccelerating. I don't share it as much anymore, especially if they wait until November to do the first cut, because I think by then growth will have slowed enough, the consumer will have locked in a pullback in demand, and just mathematically, in order for inflation to reaccelerate, we would need demand to pick back up again. And I think by November, people will be pulling back enough, if not spooked, because the labor market has cooled, that they won't have enough demand coming back in to drive inflation higher. There are a few things suggesting that the Fed funds rate should be lower than it is now, or that it's overly restrictive. I'm not saying that it's out of bounds with where it should have been, or that it's historically too high, because agreed, it's right around where it's been historically during inflationary periods, if not below that. But if you look at something like the Taylor rule, which is the relationship between unemployment and inflation, the Fed funds rate should be somewhere maybe in the high fours, if not in the mid fours. And then if you look at even just the 2-year treasury yield, the market is saying that the Fed funds rate should be far below where it is now. So some of those aspects of it, I think, will also keep a lid on market expectations. And it hopefully prevents us from getting way too far over our skis on loosening of monetary conditions and getting too far in the demand of just financial assets, which I think is where we were before this shakeout happened. We were way too overextended, particularly in a handful of securities. So I think now some of these dislocations and the market sending a clear signal that, okay, we're too tight, we got to do something sooner rather than later, will hopefully keep a lid on this. And if the Fed waits long enough, I don't think that reacceleration of inflation is coming.
Yeah. Listen, Pat, we really appreciate your work. We appreciate you being here with us. When you have another bold call that is contrarian like this, or any call actually, come back to us, because this was great stuff. We really appreciate you being here. Thanks so much.
Yeah, thank you. Appreciate the time.
I like
All right,
Pat.
guys.
We got to have Pat back. I dig Pat.
We got to have Pat back. I love the call. I love, anytime you see some sort of analyst strategist put themselves out there like that, and he's got the goods. He came with a really sound thought process. If you want to get more of what Pat Reilly or our friend Butters or any of the kind of analytics team over there at FactSet, you know where to go. insight.factset.com/subscribe. That's a much better handle, Liz, than yours. We're going to get to your handle where you get your report, but you can have the earnings insight and all this other work in your inbox. Go subscribe. We appreciate Pat being here. Liz, you do this thing every week, and I know you write this report for your customers, your members, but you also, Liz has a dual mandate guy with this. She also likes to just annoy you with, the titles and some things. So I love Liz's dual mandate: serve your members, but also annoy guy. Does that make sense?
Yes.
Talk to us about what you are focused on this week.
This was like accidentally on purpose. I annoyed guy with up, down, and all around.
Yeah.
This was just basically, let's review what's happened. We've had a whiplash 5-day period, and it freaked people out. And I think investors are sitting here scratching their heads about, is this durable? We're on edge about everything. I already talked about a decent amount of what I wrote in this note. The bulk of the center of it is that pullbacks are not emergencies. And I think we've been probably hoping for a pullback so that if you're not in the stocks that you wanted to be in, you would have an entry point. So the fact that the market started to really beg for rate cuts in a very dramatic way just because of a 3-day period of volatility just shows me that this market is in a different environment than it's been in for a long time. I already talked about the spread between the Fed funds rate and the 2-year yield, but here's some perspective on that. So the difference between the effective Fed funds rate, say that 10 times fast, and the 2-year treasury yield is about 130 basis points right now. That is the widest it's been since 2008. That's not a good stat. We don't want to hear things like that. And it's in the 3rd percentile since 1976. Okay. And remember what happened in the 70s, Guy. I know you remember what happened in the 70s because you talked about it earlier. That wasn't an old guy joke. That was just the indication that we had an inflation problem, a reacceleration in inflation. But nonetheless, just volatility around rates in the 70s was at a high. So since 1976, this is the 3rd percentile of a spread between these two metrics. What does this mean? Why do we care? Because typically when that lighter blue line is going down, it's that the market is expecting a recession, or at least the odds of a recession have risen. Now, this does not mean that a recession is coming. I want to be very clear about that. What I actually think this means is that we got more balanced, and I'm thankful for it, because before we weren't talking about, as market participants or the market at large, wasn't talking about a recession whatsoever. It was almost as if it had been decided that this was going to be a soft landing. So now here we are. We're starting to bake back in the possibility that it might not be as soft of a landing. I think this is a much healthier place to be. Now, I'd like to see these two lines converge because that's what they should do. And as we know, when things start to act as they don't typically, there has to be some kind of mean reversion. And it's typically not something that is wrought with daisies and sunshine. So something has to happen here to bring these two lines closer together. But I think that this is a good indication that risks have gotten a little bit more balanced. Investors have gotten a little bit more rational about how this might end, and that it may not all be sunshine and unicorns. And perhaps if we needed a gentle reminder that our portfolios should be diversified, that was it.
Love the commentary. Love these charts. Let me say this as well. Again, I say this, I'm not an economist, so I can't speak to whether or not we're going into a recession, we're in one. None of those things. And quite frankly, I'm not quite certain if it matters statistically, because a lot of people have been in one or something worse for quite some time, which has manifested itself in a number of different ways, not least of which this current administration's approval rating or lack thereof when it comes to the economy, number one. Number two, I'm not so sure why they get so apoplectic when they hear it, because historically, recessions are a natural part of the economic cycle, the business cycle. I mean, things slow down, old companies, bad companies go away, new companies come up. I mean, maybe it's painful, but I think it's always been essential. And the fact that we try to sort of push them out as long as we can, they just make the inevitable that much worse. But if you listen to, and I know you do, Liz, and I know Dan does as well, the commentary from so many of these retailers and so many of these restaurants, and now the layoffs we're seeing in theoretically an area in semiconductors where they should be hiring people, not firing people, it suggests that there's something brewing under the surface, Dan.
Yeah, no doubt. I mean, the consumer stuff, I guess, is most alarming. But again, maybe it's some seasonal stuff. Who knows? I mean, the enterprise, the business CapEx has not turned just yet. Okay, so that's something that is probably keeping this together. And we've talked a lot about, early 2023. We had that Silicon Valley Bank, that a lot of regionals. We had a handful go under. And Guy, you mentioned this on many occasions. One of the things that we kind of got wrong was all the liquidity that was added to the system to avoid some sort of crisis there, right? And then you had this generative AI trade that people became obsessed with, which drew this CapEx cycle, right? So we're kind of seeing all that moderate right now. But I just go back to, when the market was selling off in 2022, it was very orderly, and everyone's convinced that it was discounting the recession that was going to happen in 2023. And I think the flip side right now, it probably happens later than we would expect. And I agree with you. It is the normal course of business cycles and the like. Hey, Guy, I want to bring it back to the stock market for a second here. So look at Tesla right here. And I just think this is a really interesting story. It's not too different than what we're talking about with generative AI, because Elon Musk on their last call said, for all intents and purposes, they are an AI story. Okay. They talked about, if you don't believe that they can kind of fix autonomy or figure out autonomy, and they're not going to get to robo-taxi, he said on the call, you should sell the stock. Okay. In the last month, the stock's down 30% after that crazy rip. A lot of that rip had to do with some of the things that we're talking about, full self-driving and the like here. Also, in that period of time, the company was supposed to get delivered a $500 million worth of these H100, these high-end GPUs. Now, why do I bring that up? They diverted them to XAI. It's a company that's outside of Tesla, right? He said they couldn't use them for a whole host of reasons. Well, here's the thing about full self-driving and autonomous vehicles. They don't use LiDAR. They're using basically, complex group of cameras that are run on generative AI. Okay. So he can't use those chips, but it's all in on robotaxi. I think that's really interesting. I want to bring up a stock today. It's Luminar. Okay. So this is a LiDAR company. So Waymo and the other ones, they're using LiDAR. Okay. Which is a technology where it goes on top of the car and it's reading things in a different way. All right. Then I want to go to Mobileye. You remember that one, right, Guy? I mean, this also, look at how
it's a great James Bond movie.
Yeah, GoldenEye. Look at how that was the first Pierce Brosnan,
who sucked, by the way. Can I tell you something?
I loved him as Bond.
Daniel Craig is James Bond. When you think about James Bond, it's Daniel Craig. I mean, Sean Connery. I mean, seriously, stud. And Roger Moore. I don't think people fully appreciated the genius of Roger Moore. That's just me. Back to you.
Well, you didn't bring up Timothy Dalton, and you should have brought up.
No, I did not actually.
For her Secret Service, was that the one? And who is that? Who was that?
There was one cat that was in it. He was
I
just want
to put a point. Lazenby. His name was Lazenby. That's actually a great Bond movie, and I think that a lot of folks don't even know it exists. So I want to pull up this LAZR really quickly. Okay, this has been dying a slow death. And then I want to pull up Mobileye, MBLY, and Intel's a huge shareholder that they spun that out. Let's pull up Mobileye for a second here. So this is not too different, Guy, than what we've seen in the supply chain, of generative AI, in my opinion. So for whatever that's worth, I just think it's important to point out. Guy, anything in the stock market that's catching your eye today?
Well, if you look at the way the banks traded, I don't know if you pull up like Bank of America or Citi or something, they had a big ramp higher, and they've starting to give it back during the day. I don't know if BAC, if you could do a shorter term chart, you'll see. By the way, I know we talked about this when BAC was a $42 stock and they reported, we actually said that it's not going to stay here. It's going to trade down to book value, which was 34.69, I think. And look what the recent low was. So that one we got. But, if banks, which again started the day sort of on the high, starting to reverse a little bit, if they give it back into the close, that's clearly something I'm watching pretty closely.
Liz, anything on the sector front that you want to keep an eye on here? Any of those defensive sectors? We've talked about staples. We talked about utilities. I mean, do you want to be a little defensive here?
I do.
Yeah.
Yeah. And it's not, and I've said this before, and I always want to be clear about it. It's not just that I'm calling for being defensive. It's the sectors that tend to do well when the yield curve is steepening. And I think that's going to keep happening. I mentioned it earlier in the show. We saw it on invert very briefly. I think that's just the warning sign for the fact that it's coming eventually. And as the Fed cuts, it mathematically has to happen over time. So the sectors that tend to do well in that environment are the ones that are paying dividends. Translation, the ones that will give you a yield as your cash yields are coming down because the Fed is cutting rates. What happened yesterday is you saw sectors, REITs were the best performing sector yesterday, and that was on a day when rates didn't really fall. So I think yesterday was really just a redo of what went down terribly on Monday. I don't think that REIT thing is going to hold, but I think that there are some short-term moves that could hold. Things like if rates do come down a little bit more, and if we get a little bit more optimistic cyclically, then you've got REITs that probably do well. Financials probably do okay for a while. But as the data continues to cool, you have to be careful with those cyclical trades.
Look at that. Guy, do you want to take a couple questions? You're all knotted up, which means
I got a couple questions. Timmy and Jacob are grabbing some questions here. So bear with me as I go to my little telephone. This is from iPrivate. I haven't seen this name before. Hey guys, really enjoy Risk Reversal. Thank you. Look at that dog. That is a King Charles Cavalier Spaniel, by the way. You can correct me if I'm wrong. Wow. Has anyone considered the effects of job losses due to AI? We talk about it. It's funny, Dan, and I'm a bit of a historian, but if you go throughout history, all technological change has been sort of, people put the Heisman out, oh my God, you're going to eliminate jobs. And that's been true since the dawn of mankind. And it's true now. The problem, of course, is things happen a lot faster now, I would think. So there will be the other side of this AI thing where jobs are probably created. And a lot of people talk about that. The problem is getting there. And I think we're sort of in the early stages of getting there. And I think getting there is going to be a little painful on the employment front.
Yeah, I'll just say this. So some of the early use cases for generative AI is really like customer service, right? So a company, Klarna, which is a private company, it's readying to go public probably late this year, early next. They were talking about how they're using kind of some of these, chat bots, these new fangled chat bots. They were able to cut 700 jobs. Okay. So what's different this time, a lot of folks will go back to the automatic teller machine. That's what Guy calls. He still doesn't do that. Guy,
machine.
No, I know. You walk into the bank and you still, balance your checkbook and all that sort of thing.
Well, you say that like I hear the sense of derogatory tone in that.
Right.
Why is that a bad thing?
So some of the thought.
Why are there applications now that do it for you?
Yeah.
Is that like a thing? Like you can do it on your phone?
Yeah.
I mean, please.
So the point was,
do we want? Now I'm getting. See, now you
again. They were going to put
the Yankees Yankees have a doubleheader today. They're playing great baseball. I'm in a really good friggin' mood.
They're not playing. It's so wet out there.
No, it's 4:00. The game.
Let me just finish this.
Then,
point. Let me just finish.
Go ahead.
Okay. So the whole idea was that they're going to put bank tellers out of business, right? And they're going to put those tubes out of business. Remember when you'd go to the bank teller?
Yeah, I used to be a bank teller.
Yeah. Okay. Well, they basically figured out other things to do for them, and they kind of expanded the services that a local bank would do, or that sort of thing. So again, prior to the pandemic, we were talking about all the machines taking the jobs and all that sort of stuff, and universal basic income and all that sort of stuff. Well, when Amazon was building out their logistics during the pandemic, they had to hire a lot of people. You know what I mean? So again, I think it's a ways off.
And I don't want to spend too much time on this point, but there are fewer tellers in the windows, right? The tellers still exist.
No, that was the whole point. But now they're doing other things. They're writing mortgages. Sure. They're like doing a whole.
So the shift that has to happen. It's first of all, it's never I'm talking to iPrivate now. It's never as extreme as we fear, right? It's not as if all of these jobs get wiped out and people are sent home and sitting on their couches. But there is a I guess, a transition that has to occur that takes a while. Some of it is demographic too. So if it's a lot of people in the baby boomer era who are put out of jobs, maybe they only have another 5 to 10 years to work. They're probably not going to learn an entirely new skill set. But something that's happened in the last 10 to 15 years, I think actually Amazon was one of the leaders of this, is that companies started to commit to keeping their employees on board and providing the education necessary to train them for new jobs that did exist, even if the one that they had was eliminated. So we do find ways, corporations find ways, the economy finds ways to make it less dramatic and less painful than I think what we fear on the top of it.
Any you watching the Olympics, Dan, Elizabeth? Yes.
I haven't
Yes.
watched a minute.
Yes, I
I
have.
haven't watched a minute.
Maybe
Don't
not every
find it
night, but I
interesting.
do watch. Yeah.
So I've watched a little bit, and you know what I'm always amazed by at any of these events is the audience, the crowd, the people in the crowd.
Yeah.
That's what they do. Now let me ask you a question. Isn't the greatest isn't it your eyes, isn't watching, experiencing it yourself, just enjoying the moment? Because I ask you this, Dan, of all the videos you take at these games, I mean, do you go back and watch them? Oh, I remember when Derek Jeter. People, put your fucking cameras down. Am I allowed to say that?
Well, you just
cut
did.
that part out, Jacob. I mean, that also is embarrassing.
Well, guys,
That's a whole generation is just wasting their lives.
Hold on a second. Did you used to keep your ticket stubs?
Yeah,
back
100%. I still have them. You want me to get them out? I have my ticket stubs.
I get it, dude. But like now,
I have them hanging out. I have them hanging,
guy. But there's no more ticket stubs.
Yeah,
so
I know that makes me friggin' crazy.
So I go to about 20 concerts a year. I keep my phone 99% of the time in my pocket, but I always take one little clip, maybe a minute and a half or something like that. And I have a whole file of those. And I think that's pretty cool. And when I'm your age, I'm going to go back and I'm going to look at these things and I'm going to feel pretty cool about this sort of stuff.
Yeah.
So again, and I don't even need to drop an F-bomb to kind of hit you back, you know?
Yeah,
right.
that's different. That's different than videotaping the whole concert.
Yeah.
I mean, look at her playing the middle ground here. It's a whole thing.
Liz and I have been to a concert together, by the way. Oh, don't tell them who you want to get them fired up. Tell them what concert we went to.
Do you know what DMB stands for?
Department of Motor Vehicles.
No, it was a
DMB.
B.
Dave Matthews Band.
Think John
Oh
Alays.
my God.
Yeah.
Dave Matthews Band. They really
suck. I didn't mean
no, I'm just telling you. I know people. I'm not dropping names. I know people in the band. They think the band sucks. Like they got to gear themselves up to play because we really suck, but we're gonna play.
All right, guy. Let's take one other question before we get out of here.
Okay, sorry. It's just really bad. This is from Adam B. Hello, Adam. This is for Dan. I can't do options in my 401k investment account. What are some good ways to manage risk without using options? That's a great hat. Is that a cardinal hat? It's a nice hat. Put a shirt on, by the way, dude. You're embarrassing yourself.
I got a couple things.
Right, Elizabeth? I mean,
that you should look, especially if you know how to trade options. Okay, a lot of 401ks do allow you to do so. So if you're really into it and you really want to do it, you really want to manage risk. It's easy to roll over 401ks, okay, to other folks. And I know that a lot of them use it. Okay, that's A. B, to manage risk. Okay, the first and foremost is reduce your position size if you're really worried about that sort of thing. Guy and I talk about this all the time. Now we're in a very different environment. The volatility bands have widened a great deal, right? And so when you think about that sort of thing, you're going to have more risk in this sort of environment than you might like to. So I think about it a couple ways. You might be able to use ETFs, and listen, we don't want people to go around shorting stocks, and we talk about that a little bit. I mean, we're more active traders but if you short an ETF, like one of these sector ETFs, you don't have to worry about the company getting bought out or anything like that, right? It could just be a near-term placeholder against a portfolio of stocks that might track towards that ETF and allows you to stay in the individual names. Now, understanding that individual names have idiosyncratic risk, right? To the downside, to the upside, that sort of thing. So I would just say that obviously using sector ETFs or index ETFs is one way to do that.
All right,
really
quick. We get.
Hold
go ahead, Elizabeth.
And this might be something that you already know, Adam, but check and make sure that they don't have a self-directed 401k option, because that's probably where you can do it. Now, there'll still be limitations. You probably can only do covered calls and puts or something like that, but you likely do have the option in there.
A couple people asking about it's both Dave _I and Market Chatter with Lee J. I mean, does anybody just have a name like Tom? It's like anyway. Can you guys talk about gold and silver real quick? Again, everything that Elizabeth was talking about earlier, she was hesitant to call it a currency crisis for good reason, but all that is going on in the world with the bond markets globally, these currency moves lend themselves to exactly what we should continue to see in gold specifically, but at some point silver. The problem with silver is, if there is a problem, it has a bit of a more industrial bend. So if things do slow down, that will create a bit of a headwind for silver. But in terms of gold, I think the world is shaping up and aligning itself where gold, which has been on a pause over the last couple of weeks, will get back on its horse, Dan Nathan.
Yeah, one thing, and I mentioned this before to you, Guy. U2, Joshua Tree, 1987. A B-side was Silver and Gold. It was a great song. It is a great song. They played it in Rattle and Hum, which was their live album that was coupled with
probably not a great song.
All right. That's it, Guy. We covered a lot of ground.
I think U2 is. I think U2 is. I said it last night on Fast Money. Huh? Pat, I love Pat Reilly
from FactSet. That was awesome. We really appreciate that. Liz, we always appreciate you here in the studio with us. Guy, we got to talk about, what is it, week 13 of
Matrix.
the Matrix?
By the way, Brunson was named the captain of the New York Knicks.
He's the man.
Yesterday. Which,
really quickly, what's going on here is, it's a daily podcast. It drops shortly after the close. Our team, we curate what we think are 10 of the most important stories in the markets and in business. We jam it into a large language model, gives us a nice little text that's summarizing it. Then we put it into a voice bot. We call it Brunson. It's there under 10 minutes every day, shortly after the opening. Go find it, follow it, rate it, review it, share it. We think you're going to like it.
I had fun today. Yankees play at 4:15, I believe. The Chicago White Sox are 22. It's hard to understate or overstate how shitty they are. They're 22-88, Elizabeth, as you look on your little red phone. It's historically shitty. As a matter of fact, it's so bad that they should just stop. They actually won yesterday. They snapped a 21-game losing streak, I believe. So any of you White Sox fans out there, Mets lost in Colorado. They continue to sort of quasi-suck, but not suck enough for my liking. But they play again out there. Yankees, as I mentioned, have a twin bill with the Halos, as they say. So we'll see how that plays out. Yankees seemingly have righted the ship. But that's it, as Elizabeth texts away on her phone. Who are you talking to?
I'm looking at the MLB app, just making sure the Brewers are still in first.
The Brewers are right there. The Brewers are right there. They're fine. They're fine. Dan, you want to Dan's annoyed by me because I made fun of people.
Well, I have a 2 o'clock call, guy, that I have to jump on. So this was a lot of fun.
If you're going to the Yankee game today, and if you bring your phone out Anthony Volpe's up. I want to take a video of this. I mean,
all right.
Think of Guy Adami as you.
Liz, we're kind of
think of me.
We got them all tuned up on a couple different things here. So all right,
the Dave Matthews thing put me over the edge. It really did.
Yeah, we did. Guy, I'll see you later on CNBC's Fast Money at 5 o'clock. Very special episode with Brian Sullivan. How about that, Guy?
It's going to be.
All right.
We thought last night was off the rails. Wait till tonight, people.
All right, people. Tune in. Thanks so much for being here.